Hey, what's up, my friend? So, in today's episode, I want to talk about the five things. The five things that I look for before I place a trade. Because I know trading, it can be daunting, especially those of you who are new to this business, right? Is this the right time to enter a trade? When should I buy? When should I sell? Am I too late to the party? Am I too early? Do I need to wait for more confirmation? Yada, yada. So, these five things, right, will help you navigate the markets, right, and make you feel more confident, right, before you put on a trade. The first thing that I look for is a market structure. What do I mean by this? So this simply means, right, I ask myself, what is the current market structure? Is the market in an uptrend? Is it in a downtrend? Is it in a range? So once I can define the current market structure, then I know what to do. If the market is in an uptrend, then I will look to either buy the dips or buy the breakouts. If the market is in a downtrend, then I look to sell the rallies or sell the breakdown. If the market is in a range, then I look to sell at resistance or look to buy at support. That's it, right? Once you have defined the market structure, then you know what you should be doing to be buying, selling, or whatnot. Number two, I'll ask myself, where is the area of value? So what I mean by this is, for example, the market can be in an uptrend, but the price might be in no man's land, right? It could just, break up to all-time highs, and the price right now is in uncharted territory. And at this point, I don't want to be buying because the price is not at an area of value. So how do you define an area of value? Well, there are a few ways to it. You can define it using, support resistance. For example, market is in an uptrend, you can wait for it to retest the previous resistance that could become support. Or you can wait for the price to retest a specific moving average that the market respects, like the 50-day moving average. Or you could wait for it to retest the, let's say, the trend line, the upward trend line, or whatsoever. So this area of value would vary depending on market conditions, depending on how strong the trend is, how healthy it is, or how weak the trend is. Okay, so the second thing I look for is to see where the price is relative to the area of value. If it's far away from it, I won't take the trade. If the price is near an area of value that I want to be trading from, then hey, that gets my attention. And this brings me to number three. Number three is the entry trigger. What is the thing, right? The setup, the pattern that will get me into a trade. So the market could be in an uptrend. Then it come into an area of value, maybe an area of, previous resistance turn support. And right now I'm waiting for an entry trigger to confirm my hypothesis, to confirm that the buyers are about to step in and push the price higher. So for entry trigger, there are many variations again, right? Many types to it. You can look for something as simple as candlestick patterns, like a bullish hammer, a bullish engulfing pattern. You could look for an RSI crossing above 30. You could go down to a lower time frame, right, and look for a break of structure, looking for the price to make a series of higher highs and higher lows before you enter a trade. Those are all different ways, right, that you can use to enter a trade. Those are different types of entry trigger that you can use. And once I have a valid entry trigger, the next thing I'll do is my exits. And my exits, right, can be broken down into two parts. The exit when I am wrong, meaning, where will I exit the trade if I'm wrong? And where will I exit the trade if I'm right? So let's talk about where will I exit the trade if I'm wrong, otherwise known as your stop loss. So for me, right, a principle that I always follow is that I want to place my stop loss at a level where if the price reaches it, it invalidates my trading setup. So what does it mean, right? So let's say I am looking to buy in an uptrend. I'm looking to buy at an area of support in an uptrend. So clearly, my stop loss got to be below that area of support, right? Because if the price were to break below that area of support and hit my stop loss, then clearly it's telling me that that area of support is no longer holding. So my stop loss has to be at a level where if it's reached, I know support is broken. I know that I want to get out of the trade. Okay, so it doesn't matter what trading setup you're using. You could be trading breakouts, you could be trading a reversal trading or whatsoever. The concept applies the same. Your stop loss must be at a level where if the price reaches it, it invalidates your trading setup. So let me give you another example. Let's say you trade a head and shoulders pattern, right? Head and shoulders pattern. So at what price point will the head and shoulders pattern be invalidated? Well, if you know that a head and shoulders, you have a left shoulder, you have the head, you have the right shoulder. So it would make sense that your stop loss, right, should go above the head. Because if the price breaks below the neckline, and then you reverse up higher and take out the highs of the head, then clearly that head and shoulders pattern doesn't look like a head and shoulders pattern anymore. It looks like a weird up and down pattern. Okay, so that's what I mean by having your stop loss, right, at a level that invalidates your trading setup. And once we have defined that stop loss, once we have defined the exit when we are wrong, then the next question is, where do we exit if we are right? If the market goes in our favor, where do we exit the trade? And this brings me, right, to the first part that I touched upon earlier, the market structure. Alright, I like to exit my trade based on the market structure I'm seeing. So let me give you an example. If I see a trend, it's in a strong trend, right? The price has, been above, has stayed above the 20-day moving average for quite a long period of time. And it's still above it. So it tells me that the trend is strong. So let's say I got in at a good entry price, right? For this type of market condition, I want to trail my stop loss because I have no idea how far, right, this trend could go. It could continue going for the next few days, next few weeks, and I want to ride this trend because it's strong. Because it's strong and it's relatively easy to hold this type of trades as the trend, just goes up higher day after day with little to no pullbacks. So for such market condition, in a strong trending market, I want to trail my stop loss and ride the trend. And sometimes you might not be trading trends, you might be trading, let's say, a range. You know that the market is contained between the highs and the lows. So if let's say I happen to buy at support, in this case, I want to sell my position, right, just before resistance, because I know that there would be potential selling pressure lurking at resistance. So in this case, if the market is in a range, right, I want to look to capture a swing in the market. I don't want to look to capture a trend, right, because the odds are not quite with me, because I will have to expect the resistance to break and the market to trend out higher. Odds are pretty slim, so I'd rather just capture a swing at the highs and exit the trade. And another thing is that sometimes, right, you might have the anticipation, right, that the highs of the range will break out. The price might, trend higher. If that's the case, then what you can do is you can exit a certain amount of your position at the highs of the range and then ride the remaining half, right, to see if you can capture a trend if it occurs. So that's another way you can go about it, right? If you have some kind of a hunch or a feeling or a higher time frame analysis that tells you that, the range is about to break out. So that's another thing that you can do. All right, so in essence, right, the 5 things I look for before I enter a trade is very simple. Number 1, market structure. Number 2, area of value. Number 3, entry trigger. Number 4, your exits, which deals with exits if you are right and exits when you're wrong. And if you boil it down, right, this is what I call the May formula. M-A-E-E, the May formula. So with that said, right, I hope you got some value out of it. I wish you good luck and good trading. I will talk to you soon.